Hello, everyone. A warm welcome to the special weekend edition of Markets Around the World. I'm K2, your guide as we dive into the latest market action, macroeconomic insights, and the critical levels you need on your radar. If you're as passionate about the markets as we are, hit that subscribe button and deepen your understanding of how these complex systems interact. Today, we've got a packed agenda, covering a wealth of data, breaking news, and a broad macro outlook. So let's jump right in and unpack what's been happening in the markets and where things might be headed. Let's get the conversation started. The US stock market wrapped up a turbulent month on a positive note, rebounding after a sharp sell-off on August 5th that marked Wall Street's worst day in nearly 2 years. However, history suggests that September could disrupt this momentum, as it's traditionally a challenging month for the markets. Historically, September has been the worst month of the year for stock market performance. The S&P 500, SPX, has averaged a 1.2% decline and has ended the month higher only 44.3% of the time since 1928, according to Dow Jones market data. NVIDIA Corp experienced a staggering $279 billion market capitalization loss on Tuesday, the largest single-day drop ever recorded for any company, according to Dow Jones market data. This sharp decline coincided with a broader sell-off in semiconductor stocks. NVIDIA shares plummeted 9.5% on Tuesday, making it one of the worst performers in the PHLX semiconductor index, which itself fell 7.75%. NVIDIA's stock has now dropped 14% since reporting its quarterly earnings last week, underscoring its influence over the chip sector. Despite the negative reaction to NVIDIA's earnings, many companies would still envy its dominant position in the industry. The US dollar's decline is accelerating as expectations of Federal Reserve interest rate cuts threaten to end its years-long run of strength. The dollar has dropped 5% from its 2024 highs, nearing its lowest level in about a year against a basket of global currencies after a sharp decline last month. The primary driver is the anticipated reduction in U.S. interest rates. For years, a strong U.S. economy and persistent inflation kept rates well above those in other developed countries, making dollar-denominated assets highly attractive. This dynamic kept the dollar elevated even after it surged to a 2-decade high in 2022. The U.S. bond market is nearing another recession warning, as the Treasury yield curve is close to turning positive for the first time since 2022. The 2-year Treasury yield has been higher than the 10-year yield for a record 544 trading days, according to Dow Jones market data. Yield curve inversions have been reliable predictors of past recessions, but trouble often arises when the curve flips back to positive territory. On Wednesday, the 2-year and 10-year yields were trading nearly equal at 3.78%, with the 10-year needing to close above the 2-year to officially uninvert. Homebuyers are facing record-high prices, but some U.S. markets may be headed for a correction, offering room for negotiation, according to a new report from property data firm AAPL. California, New Jersey, and Illinois had the highest concentrations of housing markets at risk of a downturn in the second quarter, with the largest cluster in the New York City metro area. AAPL measured risk based on factors like home affordability, underwater mortgages, foreclosures, and unemployment across nearly 600 counties. Certain regions show signs of potential instability, especially in coastal markets. Can the U.S. economy conquer inflation without slipping into a recession? This is the question on investors' minds, as recent economic data points to a softening economy. Recession fears began to surface in early August, when July's jobs report revealed an unemployment rate increase to 4.3%. This rise triggered the recession-indicating SOM rule and led to a sharp stock market sell-off over the following 2 trading days. The unemployment rate has become a key watch point for investors. Although the market recovered from those losses, investors remain highly sensitive to weak economic data and discussions of a potential recession. The longer-term trends in labor market and inflation data support the Federal Reserve easing interest rate policy soon and continuing to do so over the next year. The long arc shows inflation is coming down significantly, while the unemployment rate is rising faster than expected. noted Chicago Fed President Austin Goolsbee. Given these favorable inflation trends and rising unemployment, Goolsbee emphasized, "It's clear that the path forward isn't just about rate cuts soon, but also multiple cuts over the next 12 months, as reflected in the Fed's latest dot plot." Now let's dive into the data I want to share with you all. We'll begin with U.S. manufacturing has officially contracted for the fifth consecutive month, with the ISM manufacturing PMI dropping to 47.2 points, missing expectations of 47.5 points for the last month. New orders fell to 44.6 points from 47.4 in July, marking the third straight month of contraction. Manufacturing activity has now declined in 21 of the last 22 months, extending the second longest downturn in history. The most concerning part? The prices paid index jumped to 54.0 points from 52.9 in July, marking its eighth consecutive month of expansion. Rising prices amid falling output is a classic recipe for stagflation. Over the past 10 years, the S&P 500 has averaged a minus 2.3% decline in September, making it the only month with consistent negative returns. Since World War II, the average September return has been negative 0.8%. Additionally, the volatility index $VIX has spiked by an average of approximately 10% in September over the last 33 years. However, October and November typically bring a turnaround, with the S&P 500 averaging gains of plus 1.6% and plus 3.8%, respectively. As markets enter their most volatile period of the year, investors should brace for potential turbulence. Food prices in the U.S. hit a new all-time high in July. Over the past decade, food prices at home have surged by 30%, while dining out has become 51% more expensive. Since 2020 alone, food prices at home have risen 22%, and food away from home is up 27%. Meanwhile, transportation and housing costs have jumped by 27% and 24%, respectively. All of this is happening as the U.S. dollar has lost nearly 25% of its purchasing power in just 4 years, while wage growth has slowed. Basic necessities have never been less affordable. U.S. job openings dropped to 7.67 million in July, down from 7.91 million in June, marking the lowest level since January 2021. Available vacancies significantly missed expectations of 8.09 million. Since peaking in March 2022, job openings have plummeted by a staggering 4.51 million, or 38%. The most notable decline was in construction openings, which fell to 248,000 in July, their lowest level since October 2020. Additionally, the ratio of job vacancies to unemployed workers fell to 1.07 in July, aligning with 2018 levels. The U.S. labor market is now weaker than it was before the pandemic. Prediction market expectations for August jobs report have plunged by 26,000 jobs. Prediction markets anticipated 174,000 jobs to be added in August. Now, expectations have dropped to 159,000 jobs. This shift comes after reports showed private payrolls posted their smallest gain since 2021. Adding to the concern, last month's data was revised lower by 11,000 jobs. What's going on with the labor market? Prediction markets are now pricing in 4 rate cuts in 2024, totaling 100 basis points for the first time since the August 5th crash, according to Kalshi. Over the past 2 days, markets have factored in an additional rate cut for 2024. This adjustment comes as labor market data has broadly deteriorated. It's becoming clear that unemployment data is rapidly emerging as a key driver of Fed policy, alongside inflation. Let's dive into what the S&P 500 final weekly heat map reveals about the market's performance. Broadcom saw a significant decline, finishing the week down by 12.7%. The company faced a challenging period, likely influenced by broader market trends and sector-specific issues. NVIDIA also experienced a steep drop of 12.5%, reflecting concerns in the semiconductor sector. Despite its strong position in the industry, recent market sentiment has clearly impacted its stock. AMD wasn't far behind, posting a 7.7% decline. The company is navigating through a tough environment as investors weigh the potential for slower growth in the tech sector. Alphabet dropped by 6.9%, with the company facing pressure as part of a broader sell-off in technology stocks. Concerns over advertising revenue and regulatory challenges may have contributed to the decline. Apple saw a more modest, but still notable decrease of 3.9%. The tech giant's stock was affected by the overall negative sentiment in the market, though it fared slightly better than some of its peers. Microsoft managed to limit its losses to 2.7%, emerging as one of the more resilient names on the heat map. However, even this stalwart of the tech industry wasn't immune to the broader downturn. Overall, the S&P 500's heat map this week highlights significant weakness in key tech and semiconductor stocks, underscoring the sector's current volatility. Now let's take a look at the most notable earnings scheduled for this week. Monday, Oracle. Tuesday, GameStop, Dave & Buster's, Academy Sports, Plus Outdoors, Petco Wednesday, Manchester United, Designer Brands Thursday, Adobe, RH, formerly Restoration Hardware, Kroger, Big Lots, Signet Jewelers. Friday. No major earnings scheduled. The Fear and Greed Index has dropped to 39, signaling fear after last week's decline. Whether it shifts to extreme fear this week will depend on key factors like economic data, earnings reports, and market reactions to ongoing concerns. As market volatility increases, sentiment could swing sharply in either direction. Let's dive into the charts, starting with SPY on the 4-hour time frame. Bears have finally taken control, with SPY now trading below the key bear level of 549. For the upcoming week, if the price manages to break above 549, we could see further upside potential. However, if the bears maintain their grip, we might see an ABC pattern play out, especially with the upcoming CPI report this week, which could determine the next move. As I highlighted last week for QQQ, the most likely scenario is an ABC pattern. Now, we need to watch and see if this week will complete the ABC pattern. For the bull case to gain traction, the price must rise above 490, which would confirm a trend reversal. Keep an eye on how the market reacts to this key level. To conclude, let's review the key events on the horizon for this week. These are pivotal moments that could significantly impact market movements, so be sure to keep them on your radar. Apple iPhone 16. Event taking place on Monday. Apple is set to unveil its highly anticipated iPhone 16. This event typically garners massive attention, not just from tech enthusiasts but also from investors, as it can influence Apple's stock performance and the broader tech sector. Oracle earnings. Also on Monday, Oracle will report its latest earnings. As a major player in the cloud and software industry, Oracle's financial results can offer insights into the health of the tech sector and broader market sentiment. GameStop earnings. On Tuesday, GameStop will release its earnings report. This stock has been in the spotlight due to its volatility and the attention it receives from retail investors. The earnings outcome could trigger significant market reactions. US CPI inflation data. On Wednesday, the Consumer Price Index, CPI data will be released. This is a critical measure of inflation and is closely watched by the Federal Reserve as it shapes monetary policy. Any surprises here could lead to market volatility. US PPI inflation data. Thursday will see the release of the Producer Price Index PPI data, which measures inflation from the perspective of producers. Like the CPI, this data is essential for understanding inflation trends and potential impacts on Fed decisions. Jobless claims report. Also on Thursday, the weekly jobless claims report will be published. With the labor market being a focal point for investors, this data will be scrutinized for any signs of weakening or resilience. Adobe earnings. Adobe is set to report its earnings on Thursday. As a leading software company, Adobe's performance can provide insights into the demand for digital media and cloud services, which is crucial for the tech sector. US Consumer Sentiment Report. Finally, on Friday, the Consumer Sentiment Report will be released. This report reflects the confidence of consumers in the economy and can indicate future consumer spending trends, which are vital for economic growth. All right, ladies and gentlemen, that's all for this video. If you found value in this content, please hit the like button and subscribe to the channel. Thank you for watching, and I'll see you all later. Bye for now.